Welcome everybody. We're going to do a energies update over here with a specific reference to a turn in a key energy that we see is going to deliver an outlier gain to the upside. That's right. A particular commodity energy that's going to turn to the upside. We'll be detailing that in this video. We're going to do a general update on the commodity index, which is heavily energy weighted, and we're going to look at oil more broadly in terms of some of the things. Now, some of you may recall that a while back that I said there was a worry for uranium energies generally for a little bit of a softening and a weakening. And whilst we never capitulated, one of our criteria was if there was a demand destroying event, there could also be additional pressure on the energy group. As yet, that hasn't happened. In fact, we've had a booming stock market and ongoing deficits growing for the good old US of A. More recently, we've updated how it's got ever more precarious on a potential recession, and we feel that that demand destroying event is looming and there's landmines out there, but as yet, nothing has been hit. However, in the meantime, after struggling a little bit, the energies market is in a comeback. So let's get straight into it. And we'll start with the oil market, the big major. So let's go to the charts. Here they come. Okay, this is a particularly annotated chart that we've done. It came off the back of our big macro call. I encourage everybody that has any interest in the overall oil markets to follow this particular case study that we've done. We've done micro clips in the key parts of the videos on the whole case study, technicals, moving averages, OBVs, lots of learning as both a trader and investor, and also news flow as events unfold with regards to the macro call, all the way to recent highs that were called by us in and around the market. As you can see here, you can click through, and this actually was at the 129, 130, and why we went short over there on a broadening structure on a final bullish pole. So that includes the great capitulation that was caused to single digits as called by us, the subsequent reflation, and then again the localized highs that turned out to be $130 that bring us to where we are today. But let's get to the charts. What's now happening is, in spite of a reasonably firm dollar, so the dollar was weak, then it's been strong more recently for a fair bit, we are getting continual upticks on the oil price. So let's take it out of this monthly, the great falling wedge. So you might it might be just worth just recapping some of the super macro technicals here. You had a sustained lengthy period in channel in between roughly the $10 mark to the $35 mark. Eventually you got a type 3 rising wedge. We defined those in our learning materials. Squeeze, 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 volatility constriction, and melt up that eventually gave you the super highs of 147.27 on the WTI that was smashed by the events of the great financial crisis. We re-inflated. You had Russia, Ukraine Mark 1 that started there. Failure to go higher in 2014 ended up actually seeing the oil price trade lower. Again, a short call by us, lower than the previous, in my opinion, depression low, which was a seminal event and set up the structure of this falling wedge that you see over here in the big macro time frame. Let's say goodbye to those steady years of $10 to $35 and just focus on the more recent history, wipe our faces. Then eventually we had the big event as per the breakdown over here. We'd got short a couple of times over here. We even were stopped out and re-entered again a second time there. You may remember the drone strike that caused a short-term pump in the oil price that did just enough for it to run that localized high. Yes, we had to get back in, and back in we did. We broke that basing ascending grind line. You had the full Aramco and a whole bunch more that went into the downside. Then it was time to reverse what turned into a glut, and everybody had super supply. Slowly we opened back up. Everybody was resizing demand. There was no place to put the oil that was being brought onto the market. But after that got absorbed, we found ourselves caught a bit short. That led to this great rise and eventual break of the falling wedge right here. Bit of a shooting star and test on that, by the way, as we came to that capping descending grind line. You can learn about bagels, cadgels, all the descending, all the subatomic components and key aspects that are part of big established patterns such as falling and rising wedges. Anyway, we broadened, we got quite whippy in and around the $75. You can see it, and then we went into the blow off. On this big time frame, the monthly, that is actually a shooting star. We then came back down. We had a weaker rally that failed to make a new high, although we were more stable during that period, more candle bodies. That was your absolute high, just short of the $130. This was causing immense pain in terms of inflation numbers. We came out with a 9.3% roughly over about a year back, which ties in roughly with these oil highs. Oil is inflationary. Absolutely, it is. And high oil prices hurt the inflation story. Anyway, since then we've been on a downward trajectory, and this is where we were biasing to caution on the energies. You could see the grind lines across here, the squeezing, the sell-offs, etc. You also had another structure very similar to that caused us to feel a little bit bearish. You broke down out of that, but then the production cuts and the gaps of that came in, a bit of price management, and now we're seeing real support. See the hammers there, and 3 hammers in a row, almost consecutive, every second candle. And this is on quite a substantial time frame. These are not hourly hammers or 4-hourly hammers. These are week time frames illustrating buying activity coming up underneath the pricing activity. Let's highlight them again, and I'll go with a slightly fatter koki and a broader color. Hammer number 1, then a candle, hammer number 2, then another candle, hammer number 3. The smallest shows the lowering volatility, and that has set up the compression and the continual bid coming back up under the oil price for a move that is now seeing a level being taken out, in and around here. Let's go with a straight line by current price behavior. So we're now approaching the mid-80s, which is something we haven't done since around November of last year, where we broke down out of the structure probably for the full 7 or 8 months that we've now had. In fact, we're August, so November, that's almost 10 months ago. So a 10-month dip has illustrated that we were right to be cautious for the outlook of energies, and of course the cooperation this time between OPEC plus, that is all the members, Russia and the Saudi complex, on production cuts is far higher than what transpired during the events of March 2020, when they refused to agree and both pumped for maximum gains of wealth. As a result, we got a glut and we got a chronic price behavior that took it well below everyone's expectations, which was our original prediction. So as you can see, you've actually had 1, 2, 3, 4, 5, 6 consecutive weeks in a row going up. And in fact, if you include the hammer as being a green body, which you can, you've had 7 weeks in a row of upward trajectory on oil prices. So it's quite clear that in actual fact the demand for oil is there. What else is being priced in? Well, the strategic reserve in America is at all times low. Remember that part of this sell-off and this pain was Bidenomics, which was market manipulation in essence, a strategic reserve that's held aside for exceptional circumstances to get in a better election result. I think in one of the houses he continued to release that oil to create a relative oversupply to cap pricing in terms of domestic costs for the American citizens. When he came and visited the Saudis, he was received rather brusquely in comparison to how Putin and Xi of China was received. So Biden's shares in terms of his perceived influence in the great Arabic Peninsula and beyond was clearly on the wane, and he was not taken particularly seriously. As a result of this market manipulation, he got a short-term gain that saw oil actually trade below $64 at this point over here, which is what we're illustrating right there, for a while. Now, with his very low diminished, he's played that card, and now you have the rest of the world stacking against him, and we could see higher oil prices for a longer period. What do you think that does for the inflation numbers that are supposedly under control and only 3% year on year when compared to basing effects where they were previously 9.3% a year. That's obviously still an increase of 3% on a very high base. Now that oil is starting to go up, that is going to maintain. And this is the facts of inflation. It's never one in the first instance. There are many, many waves. And actually the first wave is rarely the harshest wave. So energies are certainly now in a reflation state. If we were drawing technical patterns, it could be argued that you've had some degree of, a little bit messy I would argue, but some degree of W bottom, which could produce projections. How would we say the potential for the target on the upside could be? Well, we've got a different energy where we have a very, very clean target. I would describe this one as a little dirty and rough, but nonetheless, it's worth doing. It's such a big market. Let's do it. So where would I put that neckline? Let's do it together in actual fact. I'll delete that line and you can watch me target this for the first time. Where was the key level? It seemed to me to be around the $80 mark. I would probably keep it conservative. We could push a little higher. You could see that in the midpoint here, you did in fact have a high of around 83.50, and over there on that shoulder point round about 83.32. So 83.50 might be on the cards if you were pushing a little bit more, maybe 83. So it's a little bit hard to choose a neckline. I'd rather not be too aggressive for targeting and go somewhere around 82.50 and save $1 just so that we're not too strong. It's a quarter of a way to the next one, that's 90. And then we draw a typical projection from the lowest part. I'm going to actually choose the lowest of the dips on the W bottom. I'm going to reduce the thickness of this line. It's a little dominant. And we're going to complete this projection, geometric projection forward out of a W bottom right here in front of you. In fact, for us, this pattern is on a fairly big time frame. So I'm going to clone that and project it upwards. You may not get the same value. There's a reason why we do certain things. Some of that is explained in our materials, but is it possible that you could get north of $100 again on oil if things continue in their current form and this W bottom performs? Maybe you could indeed. And this particular move above the 82.50, which was resistance there, it was resistance there, it was resistance there, is now showing after a test to the downside and a rejection. We call that the look one way, go the other way candle. It clears out some stops and absolutely runs. That is a really powerful bull candle because it has a long tail to the bottom. There's some similarities with hammers, only the body usually advances even further. So that's a key candle break. It is a seminal high momentum break. So this does give some ground to the possibility that you could be looking at $106 again or plus on the oil side. Not very pleasant indeed, especially when Biden has to replenish the strategic reserve. But we mentioned energies. What is the main energy that we put the community in? Yesterday, before this abrupt move today, we were getting in long here. This was our entry. This is, of course, natural gas. Now, I want to highlight also, we have a bit of track record with natty gas as well. I'll take you up to the monthly and then we'll bring it back down. That's actually a bit too far. Let's go weekly. You can see that you would have been a long over here on the upside HVF. You've got a broadening structure. When you break that, you get out. You then had a dip and you had an immense run. That was all the talk of the lights going out on Europe. You remember we referred to it a number of times ourselves. You got very volatile gas markets during that period. 9.6 smashed down to 5.4, smashed back up to 9.955. Essentially, you were at 10, the round number 10 virtually, back down to 5.4, then again racing back up to 8. This is very volatile natural gas period. This was in and around the run up into the winter, particularly here for the highs. So you saw July where we are now running up into the highs that were in and around August, then the crash down. The substitution for natural gas, given the costs and the whole Russia bad narrative, was causing immense volatility in the gas market, so much so that you could add the logarithmic scale to bring some sort of sense to this market. We called for a short on the break of the neckline. We were in it before. In fact, there was a smaller head and shoulder on that even before that. Let's show you the breakdown of where you once were. Understand your history to know your future. Here was a smaller in the red head and shoulders, which was indicating that the main head was going to reverse back down. That target was made, another rally. It died on the neckline of the smaller head and shoulders. Let's just show you that on a daily time frame, because that's kind of small. So we're pulling it through and we're revisiting some history on the natural gas contract. So for those that say technical analysis doesn't work, what do you mean patterns? This is just lines on a graph. We get a lot of that in the comment section from people stumbling on these things for the first time, who don't necessarily appreciate the value of pattern behavior and the likelihoods of probabilities, etc. in the market. So that was a great short, ran target, ran all the way to the neckline, which was the previous level. Beautiful head and shoulder. Look at that right shoulder. That's the blue one now, dying at the neckline of what we refer to as the monarch head and shoulder. That was the head and shoulder within the head of a bigger head and shoulder. It's called nestling of head and shoulders. This is theory that you too can learn when you look at the complexity of head and shoulders, the manners in which they manifest inside our recorded theory, and you watch us implement it with trading live in the markets, and you get in on our natural gas trades when I choose to put them on, so that you too can be part of watching the real method be implemented in practical terms. For that, hit the link below in the description, the very first, and book yourself a call. So there is the target that was made on that macro downside head and shoulder. That's from the blue one all the way down, right the way to sub 3. We said natural gas will trade sub 3. And so it did, and in actual fact, at its lows, it traded just holding on to the 2s. So sub 3 was its lowest level. It never fell out of the 2s, but it was very low 2s at one point, which brings us to where we are today. And one of the seminal trade entries that you're now a little late to, but still not that late. But if you don't know where to place a stop, please understand the market can pull back, it can revisit the neckline, you can be taken out of the trade. Being early helps because you get to lock in risk at a key point. So our entry and our trade that we shared within the community a day or so ago was the entry in and around these levels. So I'm going to drop you even further down the time frames, and we're going to break into this head and shoulders reversal. It is what is known as an inverted head and shoulders, and where it sees us in terms of our predictions on the natural gas market, and now as energy bull bias generally, where previously we were concerned about the overall energy market. So what did you get? Here's your left shoulder, big blow off in there, smack down, deep head, an attempt to rally, a broadening structure all the way up. Eventually you get our neckline, which we've chosen as the 2.9. The key level in all of this that probably wants highlighting is of course the 3 level, which was the level that was just run, that we suggested would be just run. We put that in on dark blue, and we can even fatten that line up a wee bit. So the 3 level, wow, you just got some technical resistance when you traded 3 and you traded back down below that. Fancy that on a 12-hour session, and the key round number starts to play its play. However, our neckline's at 2.9. It often forms that way. The most logical round number just below that key level of 3, and as a result, that was a triggering event that saw us begin our confidence in this pattern, and it is deemed now a triggered pattern when we were getting in at these levels with a stop just below this technical point. It was actually only a prospective pattern. However, what can happen is you can resist and return move all the way to the neckline. I'm not saying it has to do that. It can happen. So there may still be opportunities for you to get neckline entries on limit orders where you could choose to have clean, tight, lower stops. However, it's not as good as getting in when we got in, and this is what changes the risk-reward ratio. This is what changes the risk-reward ratio. You can see that this is an 11.5. People getting in long now would now, if you were chasing a long position here and having the same safety of our stop, just simply do not have the same risk-reward ratio. There's a difference between 3.55 and north of 11. And that is the cost of not being in our community. I'm sorry, it is what it is. Why? We've been watching and waiting for this. We've been watching and waiting for this. We've been observing the oil. We look at all energy markets. In fact, let's pivot on and talk about the Bloomberg Commodity Index. I'm going to go first up on the monthly basis and just show you the Bloomberg Commodity Index against the dollar index. So broadly, you can see the commodity index, which is very energy heavy, by the way. It's quite important I mention that. So let's just get this straight. I also want to make sure I'm on log scale for both of these. I'm not sure that is. Yep, it is. Good. We never can be too sure. Let's do that. Thank you. You can go away. We grab the line. Okay, so what you can see actually has occurred here, that the commodity index has had a big falling wedge all the way through that. During the same period, the dollar itself has actually been in quite a decent upward trend. Can you see that with me? Yes, sir. Yes, sir. 3 bags full, sir. I'm sure you can. So up until 2020, these are not aligned anymore. Let's just pull these charts till they're perfectly aligned underneath each other. That's better. So now we've got 2021 under 2021. And what you can see is that was largely a bear market. Then we got the events that included March 2020, and we got a major sell-off in the dollar. Initially, you got a sell-off in commodities too. That's how it works. When you get demand-destroying events, even the commodities go down, and the dollar went down too with it. However, the response to that demand-destroying events is inflationary. I'm going to just mark off all those annotations so you can see the chart better. What ends up happening is that the quantitative easing and all the money that was created ends up creating a commodity bull, which also happened to be a breakout of this falling wedge structure, which is seminal because this has been down, and down overall in terms of its commodity. That was initially because the dollar was going down, but not exclusively because the dollar was going down. You see the dollar went down, and made a secondary base low throughout this period. And that can be the argument for the first part of the bull market. However, the dollar then continued to climb. And you can see that's exactly what it did. It started to climb and made our dollar index target of around 111 that we drew for an HVF method on this very channel and shared with you before it even happened, starting at 89 on the Dixie, saying this is probably going to run 111, which is quite a bold call during that period. So you can see that squeezy Japanesey structure that we've introduced you to. Go look at our legacy videos on the dollar index if you have any doubts and see how that was called. But what you saw is that even once the dollar started to run, the commodities ran for a while. The commodities ran for a while longer. They went for a while longer until that rejection high. At what point did that come in? And you could see it's only when you got very close to the blow-off highs of the dollar index. At that point, the dollar was then moving disorderly quickly up, and that put a lid on the commodities. However, as a result of that, we got a correction. And we have been in a correction on this Bloomberg very heavy, energy heavy commodity index. By the way, it also includes other commodities as well, but it's a dominant energy commodity. Also during this period, the dollar came back and is now forming a bit of a base. So it's not perfectly exact to say that every period where you have dollar weakness, you have commodity strength and vice versa. There is without doubt a clear-cut correlation on the macro, as you can see, long sustained down period, long sustained upward period. However, you can also see that the commodity market is capable of going up in a dollar-strong environment, providing it doesn't get too disorderly. So let's drop it down from the monthly and go into the weekly and have a closer look at the broader commodity index here, which, as I say, is very heavy on the energy side. So again, if we pull this out, what we're actually seeing is a lengthy falling wedge, a squeezy Japanesey, which has probably led to a break and the beginning of some upside overall for commodities as it comes out of that falling wedge. This has actually been, it would continue to go down even on a weakening dollar over here. And then we had a strengthening dollar, it continued to go down. Again, a weakening dollar, you had a small bump over there. It probably correlates slightly with the spell of some weakness in the dollar, as you can see, down from there to there. Then we had the strengthening of the dollar, it continued down. Then we had a final spill of the dollar, and that's when we started to come out of this falling wedge on that spill. Now that the dollar's got a little bit of a bid back in, it hasn't taken away from the fact that this is a falling wedge breakout on this index. So are commodities finally starting to get some respect? Potentially, yes, and certainly the energy part of it is definitely looking like they're on the way back. Natural gas, our key energy trade of interest that we've already given to you, targeting, by the way, through the fall. Now, there is some aspects that you need to just be a tiny bit aware of, because things are never that simple. It's a global macro system with a lot of complexity. In fact, if you are subscribed to our Substack, where I share my newsletter, also if you go to themarketsniper.com and you register for our free mini-series, you'll automatically be included in this newsletter even before it's on our Substack. So go to themarketsniper.com, register for our mini-series, and you will be opted into that newsletter. But it eventually comes up on the Substack as well. We highlight that, in fact, macroeconomically, the economy is not great. So rather than just saying 4 and beyond, we could see the 4 target being performed to. However, there are caveats regarding risk in the global sustainability of the current economic environment. And we've highlighted that in the US, tax receipts are absolutely spilling, interest payments are absolutely climbing. The last time you were at this level of lows, the tech bust and the GFC, this is still heading lower potentially and could go further. We've highlighted a few other charts of Tavi's, who we interviewed today. We look forward to getting that one out maybe for this weekend, which highlight that the difference between corporate lending rates and the Fed funds rates when they get really squeezed on margin typically is associated with equity corrections. That's right. Those 3 equity corrections are the dot-com boom, the subprime events, and the CV19 events. You'll argue those were pretty seminal and were the largest 3 down legs. And now we are lower in difference between corporate yield rates and Fed fund rates than we've been before. This points to max complacency. There's great risk. And this is the not recession in our view. And can that be associated with a real sell-off in equities, which could hurt both cryptos? It could, as you saw in the commodity chart, when it initially dips, as per the Bloomberg commodities chart, which was over here, you first dipped on the events of March 2020. You can see that sell-off. So if we have a demand destroying event, you can actually get that dip at the same time. But then the dollar destruction policies kick in and the print for the whole globe, and the subsequent gain that is just post any small dip is significantly larger. So if that were to occur at any point now, of course, energies could sell off for a short spell, only to trade significantly higher later. Same effect on gold and silver. We've done a gold-specific video recently. We've highlighted these same macro aspects. So there you go. Our trade on natural gas, a potential forecast on the oil market itself, which could see north of $100 being met again. Again, subject to not having a major demand destroying event before the target is made. If we were to get that, these events never are small, as you saw from CV19, any form of lockdowns of any variety, another pandemic, another whatever, banking crisis, subprime, they're typically large and they cause great disruption. So that would have to be made before any such event occurs. We are coming to the September, the September, October, I want to say, period, which is known to have often many aspects of reality check come into it. That doesn't mean we don't stand by these targets. At the moment, our bias would be bullish on both the energies, but our primary bias is on the natural gas contract, which sold exceptionally hard on its down leg. And just to give some context to that, you will see, if I just show this, that it's quite rare that you trade that low to the two levels. It took the events of March 2020 to flush you right down to the 1.5s. But most of the time before that, and there were other contracts you were trading in and around the 3 range. So this was quite a strong and hard sell-off that had occurred. And as a result, we feel it's probably oversold right now, if such a phrase actually means anything. But it's the value of gas is going to certainly, in a perception and at a price level, appreciate from here. Okay, thank you very much for watching. See how our trade goes. That's our call. You will trade above 4. You could have got in at 2.8 if you're in our community. Now you're looking at 3s and a little more. You could be getting 11 RRRs and being early instead of getting 3s. But hey, there's nothing wrong with a 3 risk reward trade. Remember, we are not giving advice. We are sharing our opinions on the markets and how we elect to speculate to potentially take gains from the market in this environment. The fact also that this target is not all the way up top here points to the possibility that it may not necessarily return to the giddy heights just yet of the greater pre-European winter malaise as we went in from March, May, June into winter last year. Okay, thanks for watching. We appreciate a like and a share. We do this for free. This is a non-monetized channel. We aim to bring alpha, free view to you, the watcher, for this without any need for gain. The right people will know who they are and will click our links, and that is more than enough for us. You can help us by hitting the like and giving us a share to your favorite social media. If you do that, we truly appreciate it and we thank you. Also, leaving a comment for max engagement helps fool the algorithm, fool the Google algorithm into absolutely loving us, where they want to hate us for using all those dirty, naughty words that sound so dangerous, like pandemic. Okay, we'll catch you later. Thanks for watching. Bye.